Chapter 1: The Economics of a Dominant Franchise. At current gray market valuations, investors may soon be asked to pay nearly 50 times earnings for India's most important market infrastructure asset. Is that valuation justified, or is the market extrapolating a golden age of derivatives trading that regulators are actively trying to slow down? The National Stock Exchange has officially filed its Draft Red Herring Prospectus. To evaluate this asset objectively, we will structure the thesis around four core questions. How durable is the market share? How vulnerable is the revenue to regulation? Does structural growth outweigh these headwinds? And what valuation multiple is justified? First, the economics. In fiscal 2026, the NSE generated 16,601 crore rupees in operating revenue and posted a net profit of 10,302 crore rupees. That is an extraordinary 62% net profit margin. Margins like this exist because exchanges benefit from massive network effects. Liquidity naturally attracts more liquidity. Once the fixed cost infrastructure is built, the marginal cost of processing an additional trade is virtually zero. Every incremental rupee of revenue drops almost entirely to the bottom line. It is a highly robust business model, but as we will see, it is not immune to structural risks. Chapter 2: How durable is NSE's market share? Question 1. How durable is this market position? NSE handles over 36.99 billion derivative contracts globally. This dominance is underpinned by a deeply entrenched ecosystem. The Nifty indices act as the default benchmark for the Indian market, creating a structural lock-in for passive funds, algorithmic traders, and retail liquidity. Broker integration and liquidity concentration make it incredibly difficult for competitors to fragment the order book. However, the moat is evolving. A key shift is clearing interoperability. Historically, trades executed on the NSE were exclusively cleared by NSE Clearing Limited, or NCL. Today, regulatory frameworks allow brokers to route clearing to rival corporations. The data shows NCL's market share in cash market settlement slipped to 88.42% in fiscal year 26, down from 94.24% the prior year. To defend and expand its footprint, NSE is looking offshore via Gujarat's Gift City. Through its subsidiary NSEIX, it established the SGX Connect for global investors. This initiative is capturing volume, with NSEIX controlling 99.81% of the equity derivatives contracts among Gift City exchanges. Chapter 3: Structural Growth versus Regulation. Questions 2 and 3. Does India's financialization trend outweigh regulatory vulnerability? The bull case for NSE is anchored in the structural deepening of Indian capital markets, which remain under-financialized relative to developed peers. While the exchange is expanding its core footprint, with listed entities growing from 2,438 in fiscal 2024 to 2,978 in fiscal 2026. The long-term thesis extends beyond new listings. As Indian household savings continue shifting from physical assets toward financial assets, the overall transaction pool available to exchanges expands as well. With India's demat account base now exceeding 20 crore and mutual fund AUM crossing 80 lakh crore rupees, rising retail participation and increasing equity ownership create a massive secular tailwind for transaction volumes. Investors must weigh this structural growth against revenue concentration. In fiscal 2026, 78.65% of operating revenue came from transaction charges. Within that, options trading accounted for 60.22% of total revenue. Furthermore, 46.78% of operating revenue is generated by just the top 10 trading members. This reliance on options exposes NSE to regulatory compression. The DRHP details SEBI's October 2024 and May 2025 frameworks, which mandated upfront options premiums, increased contract sizes, and restricted weekly expiries to a single benchmark index. These measures resulted in a direct moderation of equity futures and options volume in fiscal 2026. The direction of regulatory policy is clear. SEBI is willing to intervene when derivatives activity becomes excessively speculative. Chapter 4: Capital Structure and the Legal Overhang. This brings us to the deal mechanics. The IPO is a 100% offer for sale, or OFS, comprising 14.89 crore shares. The State Bank of India is offering 2.47 crore shares, and the Canada Pension Plan Investment Board is offering 1.18 crore shares, among others. An OFS means the company is raising zero new capital. Most companies go public because they need money to grow. NSE is already printing so much cash that it doesn't need external funding. Existing early backers are simply using this event to take liquidity. It is also notable who is not selling. The Life Insurance Corporation of India holds a 10.72% stake and is not participating in the OFS. This could reflect long-term confidence in NSE's earnings power, but one must be careful not to automatically infer conviction, as strategic mandates and regulatory considerations heavily influence these decisions. There is also a legal overhang. In fiscal 2026, NSE recognized a 1,391 crore rupees provision for pending settlements related to the collocation and dark fiber cases. A separate settlement regarding tap architecture lapses amounted to 643 crore rupees. These are significant contingent liabilities on the balance sheet. Chapter 5: What valuation multiple is justified? Finally, question 4. What valuation is justified? Currently, the unlisted gray market values the NSE at approximately 5 lakh crore rupees. Applying that 5 lakh crore valuation against their fiscal 2026 net profit of 10,302 crore yields a price-to-earnings multiple of roughly 50 times. Whether that multiple is reasonable depends on how investors compare NSE's growth runway and market dominance against other exchange businesses globally, such as CME, ICE, LSEG, or Nasdaq. At this valuation, investors are effectively betting that future earnings growth and market dominance will offset regulatory tightening on derivatives activity. Does a 62% net profit margin and India's structural growth narrative justify a 50 times trailing earnings multiple, given the concentration in options revenue and active regulatory intervention? As the final pricing band is established, the market will ultimately decide if this premium is justified.